Now it's time to move on to Chapter 23 in Managerial Accounting, which is on flex budgets and how standard costs are used. What exactly is the purpose of the budgeting process? Yes, it is to make a plan for what is going to happen in the future. We plan to, do this much in sales, spend this much in cash on our components of production, our materials, our labor, our overhead, etc. But it also gives you a guideline to go back and compare your numbers to when you get your actual results versus what you thought was going to happen. And they call that the controlling step. And it's a decision based on managers where they look at the actual results and compare them to what happened during their budget to figure out what went wrong, what went right, how do we fix it, how do we improve our business. And this process is cyclical in nature. There is no one on the face of this earth that is good enough at budgeting where they're going to guess to the penny exactly what you're going to spend on each component of the business. You're going to do your best, but they're always going to be off. So the first step to do is to come up with your strategies, develop what you want to do, and make your plan, which is your budget, to figure out how much you expect things to cost, how you're going to stay on budget during the period. And then when you're happy with your budget, you act it out, and you realize that your numbers aren't exactly what you budgeted for. So you compare your actual results to your budgeted figures, and you determine how are we going to improve the company's performance, and that is the control step. And after you've done the controls and you've figured out ways to improve your business, you create strategies for that improvement, and from those strategies for improvement you make a new budget and you act on the new budget, and that new budget is going to be off and you're going to have to control again. So this nature of this cycle just repeats itself over and over and over again. You're always trying to improve, you're always trying to do better with budgeting, but you can't be perfect. So you need to figure out how you're going to fix things, how you're going to rectify things to improve the performance of your company over and over and over again at the end of every period. The master budget that we have prepared in Chapter 22 is what they call a static budget, because it is for one level of production. You say you're going to make 1 million units, and for 1 million units you figure out what your labor costs are going to be, what your material is going to be, etc. And that figure doesn't change anywhere through the master budget because it is one singular static figure. Well, from that figure, you need to compare your actual results to what you budgeted for. And they do that in a thing called a performance report. It basically assesses where your actual results are off from your budgeted figures through a series of variances, the difference between your actual and your budgeted amount. And the difference that you will have from your master budget is your static budget variance, the overall gap between what your actual results were and what you proposed they were going to be in your static budget. Someone, somewhere, decided that all variances should be denoted as favorable or unfavorable, good for the company or bad for the company. And to figure out if something is favorable or unfavorable, take a second, step back, and think about what will that do to our overall income, because we know revenues minus expenses equals income. Well, if you budget for an actual amount of, or you budget for a set amount of revenue and your actual revenue comes in higher, since revenues minus expenses equals income, that means higher revenues is going to lead to higher income. So having revenues above what you budgeted for is always favorable for the company. Expenses, if you end up having to pay more for materials than you planned for, revenues minus expenses gives you income. Higher expense means you're going to have lower income, which means if your actual expense is greater than what you budgeted for, that's unfavorable for the company. That's bad. Inversely, if that actual expense is less than what you budgeted for, revenues minus expenses equals income, that less expense means more income. So the lower your expenses are, the more favorable it is for your company. So figuring out if something's favorable or unfavorable all stems down to the fact, is this going to increase our income or not? And if it's a measure of revenue or a measure of income that is higher than what you planned for, that's always good. If it's a measure of expense and that it comes up to higher than what you planned for in your master budget, that's always bad. Here we have cheerful colors, and they are comparing their static budget to their actual results. Cheerful Colors makes crayons, and they budgeted in their static budget, their master budget, to make 50,000 batches of 100 crayons, and they actually made 52,000. Well, if you're making and producing and selling more than you thought you were going to, that's always good for the company. So their variance between their static budget and their actual results was 2,000 more batches, and this is more, and it's going to lead to more income eventually. That's favorable. For revenue, they planned in their static budget to have 375,000, They actually had $384,800. That's $9,800 more than they budgeted for. Having more revenue is always good for everybody. Therefore, that is a favorable static budget variance of $9,800. They had their components of their variable manufacturing costs, which were their direct materials, direct labor, and their variable overhead. For direct materials, they budgeted for $87,500, but ended up spending $104,000 on direct materials. Their actual material expenses were much higher than they budgeted for, $16,500 higher, in fact. And spending more on the inputs, the cost of production, is never good for a company's income. So that $16,500 direct material variance is unfavorable. For labor, they plan on budgeting to spend $150,000 for labor. They spent $145,600 in actuality. Spending less on the cost of production is always going to increase a company's operating income, and therefore it's always favorable. So that $4,400 difference, that variance, is favorable. For variable overhead, they spent $7,340 less than they budgeted for. That's going to be favorable. For supplies, they spent $450 more than they budgeted for. Spending more on a cost is unfavorable for the company. And overall, for their variable costs, they had a static budget amount of $293,750. That's what they thought their variable costs were going to be during their master budget. Well, they actually ended up being $298,960, which is $5,210 higher. Paying more in costs is never good for a company. That is going to be an unfavorable variance. Their contribution margin, their revenue minus their variable costs, was planned to be $81,250, but it actually ended up being $85,840, which means that their contribution margin difference, variance, was $4,590, and since their contribution margin was higher, and contribution margin is a form of income, higher income is always favorable. For fixed costs, they budgeted to have $25,000 in fixed manufacturing costs, but it came in to $23,920. That is $1,080 favorable. They budgeted to have $22,500 in selling and admin expenses. Their actual amount of selling and admin expenses were $25,600. That's $3,100 more. That is unfavorable. And in total, their fixed costs were $2,020 higher than they budgeted for. That is also unfavorable. And then lastly, for their operating income, which is just contribution margin minus fixed costs, their operating income was budgeted to be $33,750, but they actually had operating income of $36,320. So their operating income was $2,570 more than they set forth in their master budget. And higher income, always favorable for a business, so that $2,570 static budget variance to their operating income is favorable. The problem with doing measurements like we just did right there is, by nature, if you make more units, you're going to spend more on the cost of materials or the cost of labor or all your variable inputs. It's just the way things work. If you want to produce and sell more units, you have to pay your employees more hours to sit there and make product for you. So saying that something has a static budget variance that is unfavorable if you've made and sold way more units than you expected doesn't do justice to the fact that it takes money to make money. So how do you rectify that situation? You make what they call a flexible budget. And what a flexible budget does is it adjusts your input cost per unit that you make up to the actual amount that you produced and sold. So it takes different levels of your sales volume within your range and figures out what your costs should have been had you budgeted for that level of production in your original master budget. So to do this, you need your unit level inputs, as they call them, which is how much you plan to sell each unit for, what you thought your variable costs of production for each unit were going to be, and that includes your product cost, your materials, labor, and variable overhead. And it also includes any variable selling and administrative non-manufacturing costs you had. It has your budgeted fixed costs. You're going to need those as well. And then you're going to have to figure out what different levels of volume production you want to check for. So over here, Cheerful Colors has made a flex budget. And the flex budget is not just for the $50,000 that they set forth, but $48,000 and $52,000. So they're saying essentially here, if we made this many units, this is what each line item on our income statement should look like. If they made 52,000, I'll start with, boxes of crayons, sold each of them for $750, well, 52,000 times 750 is 390,000. So that's what the revenues should be if they make that many units. If there's only 50,000 they end up making, and they sell them for $750 a piece, well, their revenues should be $375,000. If they made 48,000 units and sold each box of crayons for $750, the revenue should be 360,000 units. So what you're doing for each level on your flex budget is taking that level of production and multiplying it by your budgeted amount per unit. And if they do the same concept for direct materials, 52,000 times 175 is $91,000 in direct materials it's going to cost to make 52,000 boxes of crayons. If they do indeed spend $1.75 on materials for each box, for 50,000 times 175 means the direct materials cost should be $87,500. That's the actual level of production they come up with. For 48,000, $1.75 a piece in material cost, they should spend $84,000 on direct materials to make 48,000 boxes of crayons. By that same concept for labor, they're just going to take their 3 different levels of production that they're checking for, multiply it by the cost that they're budgeting each box of crayons is going to cost for labor, which is $3, to get what their total labor cost should be for each of those 3 different levels of production. Same concept, gives them 3 different numbers for variable overhead. For supplies, they're saying it's 5% of sales, so they're taking their sales level, budgeted at each one of their different levels of production, and multiplying it by 5% to come up with what their supply costs should be at all of those different levels. And if they add together their materials, labor, variable overhead, and any variable components of their selling administrative costs, they get their total variable costs, again, for all 3 different levels of production. Their contribution margin is just their proposed revenues at that level minus their variable costs at that level. So for 48,000, it would be 360,000 minus 282,000 equals $78,000 contribution margin. And by doing this, they're basically saying, you know, instead of one static figure that they're going to produce for, this is what we should have at different levels of production, because we're not quite sure what we're going to make and sell during the period. I mean, we make product to meet customer demand. If we're making a ton of crayons and they're sitting on the shelves and we can make another product, what's the point in making more crayons? So having a flex budget gives you more levels to check against. One thing to particularly note on here, though, is the fixed cost section. No matter if they're budgeting for 48,000 boxes of crayons, 50,000 boxes of crayons, or 52,000 boxes of crayons, their variable manufacturing fixed costs are always 25,000. Their fixed manufacturing fixed costs are always 25,000, and their fixed selling and administrative costs are always 22,500. Why don't those change? Because fixed costs do not change when the level of production changes. So it doesn't matter how many different boxes of crayons they make within their relevant range. They're always going to pay that fixed cost in the same amount. So the fixed costs do not change when your level of production changes on a flex budget. And in total, for all 3 different levels, they took each level's respective contribution margin, subtracted out that $47,500 in total fixed costs to come up with each level of production's anticipated operating income. So overall, the static variance is the difference between what you budgeted for and what the actual results were. And a lot of things can go into a static budget variance. There's a lot of reasons that companies can miss what they budgeted for in their actual results. It could be because there was more customer demand, so they made more products. That would increase the revenues. It would also increase the variable costs. It could be something along the lines of the materials that they use for production became scarce, and because law of supply and demand states if something's in high demand and there's a limited amount of supply, you should jack up your price. Their vendors really increase their price, so they could have made exactly the level they produced for, but if their vendors are charging 20% more, well, their material costs are going to go up 20%. There's just so many different things that can go into it that giving just the static budget variance isn't a sufficient number to execute that control step, to make good managerial decisions. So what we need to do is we need to break it down. And we can break down that static budget variance into two components. The first one is the sales volume variance, the bottom tab. And that is the difference between what you budgeted for and your actual results. It can be purely attributed to the fact that you made and sold either more or less units. If you sold less units, your revenues are going to be lower, but you would spend less producing units because you don't have to make as many because you're not selling as many. So your material costs would be lower and your labor costs would be lower. So sales volume variance basically takes that overall difference of what happened and says this much of it is attributable to the fact that we didn't make the amount of units that we thought we were going to make. The other half that we can split that static budget variance into is the flex budget variance, and that is the portion of the difference between your actual results and what you budgeted for in your static budget, which is attributable to anything besides sales volume. So that could be your costs. It could be, federal mandate increase the price of labor. It could be your efficiency. Your employees didn't do the job that they were supposed to do as fast as you thought they were going to, and you had to pay them more for labor hours. So static budget variance can be broken into two different components: the sales volume variance and the flex budget variance. And there it is, all in one grand graphic. Again, sales volume variance portion of the static budget variance is the portion that is attributable to the volume that you produced and sold changing, and the flex budget variance, everything else. So over here we have an FBPR, a Flex Budget Performance Report. And what the Flex Budget Performance Report does is it adjusts your static budget, the numbers you sent forth in your master budget, up to, or down to, if you did less, the actual amount of units that you produced. So cheerful colors, budgeted to sell 50,000 boxes of crayons. Well, they actually sold 52,000. So if they sold 50,000 boxes of crayons at $7.50 a piece, like they set forth in their master budget, they should have had sales revenue of $375,000. Well, they actually sold 52,000 for sales revenue of $384,800. Well, revenue's higher in actual results than it was in the static budget. But again, there could be a lot of reasons for that. So let's break it down into the two parts: the portion which is attributable to sales volume increasing or decreasing, and the portion, the flex budget variance, which is attributable to anything else. And to do so, you need to start filling in the flex budget column of this FBPR. And you do so by first copying over your actual results to the flex budget column in terms of units produced and sold. So we're going to take the 52,000 units they actually produced and sold, bring that number over here to the flex budget, and then we're going to take the actual quantity that we produced and sold and multiply it by our budgeted amount per unit. If we had sold those 52,000 boxes of crayons that we actually produced at $7.50 a piece, 52,000 times 750 is $390,000. So we should have done $390,000 in sales revenue. Well, that $390,000 we should have done is $15,000 more than the static budget, and higher revenue is always good for the company. So that $15,000 difference, which can be attributed to the fact that we made those 2,000 extra boxes of crayons and sold them, is favorable. Over here, the difference between our actual results of $384,800 and the $390,000 in sales revenue we should have done means that our actual results are $5,200 less than what our flex budget states. Well, less revenue, no good. That's unfavorable. So yes, we had a $9,800 increase between our actual results, our actual sales revenue, and what we set forth in our master budget. But if we break it down, we see that had we got our actual selling price per unit, we should have done $15,000 in extra revenues, which means $5,200 decrease in our revenues can be attributed to anything else. And we'll do the same thing over here for our variable costs. In our static budget, we said that making 50,000 boxes of crayons at $1.75 a piece was going to lead to us having to pay $87,500 for direct materials. Well, we actually paid $104,000, and that overall gap between the two has too many different things that could have gone off from our budget in order to make a very informed managerial decision. So we're going to start by making our flex budget column. And to do so, we take our actual number of units, 52,000, multiply it by our budgeted amount per unit in terms of direct materials, $1.75. According to our budget, we should have spent $91,000 in direct materials to make those 52,000 boxes of crayons. So if we go to our gaps in here, our flex budget variance column and our sales volume variance column, we just find the difference between the two numbers on the end to figure out what the variance was. Well, the static budget says we should have spent $87,500 on direct materials. Our flex budget says when we adjust it up for the actual number of units we made, we should have spent $9,100. So $3,500 of that increase in our overall direct materials costs can be explained by the fact that it takes more money to buy materials when you're making more units. The other gap we have, the difference between the $104,000 we actually paid for direct materials and the $91,000 we should have paid for the flex budget, and I like to call the flex budget the should have been budget. We should have paid $91,000. Well, we paid $13,000 more than we should have. So $13,000 of that extra cost we paid can be attributed to anything else except for the increase in volume. Well, what could that anything else be? There's really two things. We either had to pay more to buy the same amount of materials, or we needed to use more materials to make products for each box than we thought we were going to. And we can break that down further later. So this concept that we're doing, we're just going to repeat all the way down the line. You're always taking the number of units that you actually made for the flex budget column, 52,000, multiplying it by your budgeted amount per unit. For labor, it'd be $3, and it gives you what you should have spent given your actual level of production and your budgeted amount per unit. So for direct labor, we should have spent $156,000, and since that's $6,000 more than we set forth in our master budget, $6,000 increase in our labor costs can be attributed to the fact that we made more units, which means we should have had to spend more in labor. Employees have to work more hours to make more boxes of crayons. However, our actual direct labor costs for the period were $145,600, which is $10,400 less than what we should have paid, given we expected to pay $3 per box of crayons in labor costs to produce it. So $10,400 favorable variance can explain the portion of the difference that we were off between our budget and our actual, which can be attributed to anything else besides an increase in sales volume. And you just do this all the way down the line. Again, for the flex budget column, always taking the actual amount of units you produced, multiplying it by your budgeted amount per unit, gives you your flex budget amount, and then you just fill in the gaps. Sales volume variance is the difference between flex budget and static budget. Flex budget variance is the difference between actual results and flex budget. And then if your number to the left, so over here for actual results, is less than your flex budget amount, you got to determine if it's favorable or unfavorable, and that determines what that line item does to your overall operating income. If it's a cost and your actual is less than it should have been, that's good for your company. It's favorable. If it's a measure of revenue and it's less than what it should have been, given your amount you expected to get per unit, well, that's unfavorable. One last point before I switch to the next slide. I'd like you to note over here for the sales volume variance for fixed costs, they're all zero. Why is that? Well, sales volume variance is adjusting for the fact that you had to make more units to be able to sell more units. But with fixed costs, they should not increase nor decrease with the quantity that you produced. So your sales volume variance for anything that is fixed should always be zero, because an increase in production levels should not, according to the way the fixed costs work, increase your fixed costs. Overall, for Cheerful Colors, they expected to have $33,750 of income in their master budget. Well, their actual results were $36,320 at the bottom. That is a static budget variance, the difference between their actual results and their master budget amount, of $2,570 more income, which sounds great. But then when you break it down, you see that $3,250 favorable of that variance can be explained by the fact that they sold 2,000 more boxes of crayons than they thought they were going to. So what drove their income up? The fact that they just made more products than they thought they were going to. The flex budget variance is 680 unfavorable. It's everything else besides sales volume. So they didn't make as much income as they should have, according to their flex budget, because something else happened. Either they used more of a product, employees had to work more hours, or they spent more on something than they planned to. So all these numbers we have in here, what something should have cost, how many hours something should take. Those are standards within our business. So a standard is the price, cost, or quantity that is expected under normal conditions for our business. In our master budget, it's what we thought, how many materials it was going to take to make each unit that we produced, how many hours of labor it was going to take, how much overhead costs each unit we produced, variable overhead costs each unit we produced was going to cause us to incur. Well, we're going to use a standard costing system, which basically states that when our numbers go up and down in terms of actual productions, we should always be basing the increase or decrease in our overall cost based upon that standard that we've set forward. And who sets these standards? Who says this is how much we should pay per hour to our employees, or this is how many hours it should take to make a box of crayons, or this is how much depreciation we're going to expect to experience on our equipment for producing units. This is how much, maintenance and repair we're going to have to do on those machines during the period. Well, the best person to come up with these standards is the person the most in the know in your company. So what about, say, the cost of our direct materials? Who that works at our company knows about that better than anyone else? And that's the purchasing manager. Their entire job is to find the best possible price for you to acquire materials of the quality that you need. Efficiency for direct materials. How many materials you're supposed to use in each unit that you produce? Who's the best person to set that standard? That's the production manager. That person is running the floor. They know what type of materials it takes for each product. They know what rate of spoilage to expect. Basically, what proportion of those direct materials that they buy get wasted. They know how the schedule works for their products. So when you need someone to set your standards for materials, if it's the cost of it, you go to your purchasing manager and say, how much should we budget for to spend on each, say, pound of wax to make crayons? If it's an efficiency standard, how many pounds of wax should it take to make each box of crayons? That's on your production manager. For labor, for cost, no one's going to know more about the cost of paying your employees than the manager of human resources. They're going to know what the current taxes are they're going to have to pay. They're going to know how much fringe benefits like paid time off and their contribution to your health insurance and stuff are going to cost. So if you're trying to figure out what your labor cost is going to be per unit, who's the person to have set that standard? The human resource manager. They're trying to figure out how much time in terms of direct labor it's going to take for production. That falls again on the production manager. They know the level of experience an employee is going to need to make one particular product, and they know, based upon that level of experience, how many hours it should take to make that one product. So the production manager is going to set your direct material efficiency standard. And then for manufacturing overhead, one more time, the production manager is a very busy person. They know all about how often your machines break down. They know how long it takes to transport materials here or there and what the shipping costs are going to be. They know how long it's going to take people to inspect your products, in this case crayons, to make sure that they're actually up to snuff and they're not going to break in little kids' hands when kindergartners are trying to draw pictures. So the production manager is the best person to set your overhead costs and efficiency standards. So for the cost standards, let's go with these numbers for Cheerful Colors when we make our crayons. For the direct materials cost standard, the purchasing manager has said net of all discounts, we pay about $1.65 per pound of paraffin, which is the type of wax used to make crayons. Plus, we have to pay for delivery, receiving. We're not going to actually transfer payments to the company we bought from until we inspect it and we make sure that wax is actually serviceable for making crayons. Well, that costs about 10 cents in cost per each pound that we get. So in total, Cheerful Colors is expecting to pay about $1.75 for each pound of wax that the company buys. For direct labor, Human Resources Manager said the flat hourly wage that we pay our average employee is about $10 per hour, Plus, we got to think about payroll and all the fringe benefits. That's going to add about $2 per hour to their hourly cost, which means the total standard cost for direct labor, according to the person most in the know, the human resource manager, should be $12 per hour. And then for your overheads, both variable and fixed, the production manager is going to go through and give a number that they think is the total amount of cost of that particular type they're going to incur for the period. So the production manager is going to go and say, our typical variable overhead costs for the level of production we're talking about are going to be about $37,500, and for fixed overhead costs are going to be about $25,000. We need some way to spread those costs amongst all the different products you make, which is your cost driver or your allocation base. So the production manager is the same person that's in charge of your efficiency standards. They would be the person most in the know to determine, how many, in this case, labor hours it's going to take your employees, and they estimate that's 12,500. Well, if we're going to use that as our driver for spreading out all of those overhead costs to the different products that we make, what you do is you take your estimated overhead cost for that type and divide it by the estimated quantity of your driver. If they think there's going to be $37,500 in overhead costs, and it's going to be spread amongst 12,500 direct labor hours, that means for each labor hour that employees spend making these boxes of crayons, Cheerful Colors should set a standard of $3 in variable overhead costs per direct labor hour worked on that product. For fixed overhead, by the same thing, you're going to take $25,000 in estimated fixed cost, divide it by the 12,500 estimated hours for direct labor that your production manager determined. And it's going to give you a predetermined allocation rate, your standard, if you will, of $2 per direct labor hour for fixed overhead. Why is this useful? Well, firstly, it's immensely helpful for preparing a master budget. If you had to go through and make your best guess as an accountant about how many hours it takes to make a product, or what you expect the discount to be on materials that you buy, that's not your area of expertise. So having someone that knows that better than you do gives you some great figures to make your master budget. And it also sets, as they call it, a benchmark. If you have a standard that says it should take this many hours for your employees to make 100 boxes of crayons, those employees are going to know that, and they're not going to want to come in at a time way above the standard that has been set for them. Same thing for your purchasing manager. If you say this is what we expect to pay for a pound of paraffin wax to make crayons, they're not going to be content paying more than that, because they're fully aware that that is the standard that's been set for them. So having these standards in place basically sets a level for management to gauge, are employees doing what they're supposed to be doing? And by having these standards in place and, controlling, I guess, the level of production and the cost of production for your company, it allows you to more efficiently set your sales price so that you can make the level of income that you expect to make. So we have our two variances that we start with. We have the sales volume variance, which was the portion of an increase between a portion of a change between our actual results and our static budget that could be attributed to an increase or decrease in sales volume. And then we had the everything else, the flex budget variance. Well, that's not very helpful to go to somebody and say, well, sorry, Mr. CEO, but we were off by $16,000. It could have been caused by anything else. That's not going to look like you're doing your job. So that anything else variance, that flex budget variance, can be broken down into two different components: your cost variance and your efficiency variance. So the portion of that anything else which can be attributed to an increase or decrease in the cost of your inputs, or the portion of that anything else which can be attributed to having to use more or less of materials, hours, etc., to produce the level of units that you made. And to figure out your variances, you need to isolate one variable to it. For cost variance, what you do is you're figuring out the difference in your cost from what you actually paid versus what you set forth in the standard by taking your actual costs times the actual quantity of the input that you had, so the pounds of direct materials, the hours of direct labor, and subtracting out your standard cost, what you should have paid, times your actual quantity. And since there's actual quantity in both of these, what you're finding is the difference between your actual cost and your standard cost, the cost variance. For your efficiency variance, you take your standard cost times that actual quantity, and you subtract out the standard cost times the standard quantity allowed, which is a fancy way of saying the quantity you should have used given your standards. And doing so allows you to figure out, did we use more or less materials than we thought we were going to? Did it take more or less hours than we thought it was going to? So for the cost variance, this second formula down here, actual cost minus standard cost times actual quantity, is the easier way, in my opinion, to break this down. The cost variance for anything, any component of your production, can be found by taking your actual cost, subtracting out your standard cost, and multiplying that difference by your actual quantity. The efficiency variance, again, can be found by taking your actual quantity, subtracting out your standard quantity to find the difference in the quantity that you used between what should have been and what actually happened, and then multiplying that by your standard cost per input. So how many pounds of paraffin wax should it take? How many hours it should take to make 1 unit? And now we're really breaking things down. So we had our static budget variance, the difference between what we budgeted for and what actually happened. Well, we broke that down into two different components. The portion of that static budget variance was attributed to an increase or a decrease in sales volume, and the portion that's attributed to anything else. And saying anything else isn't sufficient, so we broke that flex budget variance down even further into the portion of our overall difference between our budgeted amount and our actual results, which could be attributed to a change in the cost of our inputs, and the difference of that overall static budget variance, which can be attributed to how efficient we were producing these goods. So here, back to cheerful colors, they had a flex budget variance of $13,000 for direct materials. Again, flex budget is what should have been to make 52,000 boxes of crayons at $1.75 a piece. It should have cost $91,000, but we can see right here it was actually $104,000. So they had a $13,000 unfavorable direct materials variance. For direct labor, their actual cost of $145,600 was $10,400 less than what they should have had to pay for labor of $156,000 to make the boxes of crayons. They had an $8,840 variable overhead variance that was favorable, and they had a $1,080 fixed overhead variance that was favorable. Well, now let's break that down from being anything else into what portion of that can be attributed to a change in price and what portion of that can be attributed to inefficiency or increased efficiency. So let's do our direct materials variances first. Our flex budget variance was $13,000 unfavorable. We spent $13,000 more on materials than we should have according to our flex budget. Now let's figure out what portion of that is because of the price of paraffin wax change, or what portion of that is attributable to the fact that we had to use more or less paraffin wax than we thought we were going to. And to do that, we're going to need our standards. So our standards from the purchasing manager, we should have paid $1.75 per pound for paraffin wax. From the production manager, we should have used 1 pound of wax for every batch of crayons that we made. Well, we actually used 65,000 pounds of crayons, and 65,000 pounds of wax, and we actually paid $104,000 for that wax. Well, to figure out our cost variance, we take our actual cost per pound and subtract out our standard cost per pound, and then multiply that by the actual quantity of direct materials that we used. So our actual cost per pound was $1.60. How did that number come about? Well, we spent $104,000 to acquire and use 65,000 pounds, and 104,000 divided by 65,000 is $1.60. So we spent $1.60 per pound of wax. Well, our purchasing manager said it should cost about $1.75 per pound when we started. So we actually paid less per pound than we thought we were going to when we set our standard. And if we multiply that 15 cents in savings we had for each pound or the 65,000 pounds that we purchased, we see that $9,750 of the change in our flex budget variance, favorable, can be attributed to the fact that we paid less per pound of material than we thought we were going to. Well, the other thing that we can break that flex budget variance down into is our efficiency variance, which is found by taking your actual quantity and subtracting out your standard quantity and then multiplying that by your standard cost. So our actual quantity was 65,000 pounds that we used. We made 52,000 batches of crayons, and in our standard we said it should take about 1 pound per batch of crayons that we make. So to make 52,000 batches should have taken 52,000 pounds. That's why that's our standard quantity, which means we used 13,000 pounds more than we thought we were going to. And if we take that 13,000 pound increase and multiply it by the standard cost we set forth per paraffin wax of $1.75 per pound, that comes out to $22,750 unfavorable. So backing up a little bit here, we started with a $13,000 unfavorable variance, which could be attributed to anything else besides the fact that we made and sold more boxes of crayons. Well, what is it attributed to? It's either cost or efficiency. And as we see here, it wasn't our cost. Our purchasing manager did a great job. They got the wax cheaper than we thought we were going to. It's entirely attributable to efficiency. We used way more boxes or wax to make those batches of crayons than we thought we were going to. So if you are a manager and you're trying to improve the quality of your business, the first thing you need to do right here is go to your production manager and inquire why you used so many more pounds of wax than you thought you were going to. Let's do the same thing for direct labor. For direct labor, we had a $10,400 favorable variance overall. So we spent much less on direct labor costs than we should have according to our flex budget. What are our standards related to direct labor? Our standard for cost is $12 per labor hour. Our efficiency standard is 0.25 labor hours per batch of crayons, so it should take about a quarter of an hour or 15 minutes to make a batch of crayons. Well, we actually spent 10,400 hours making crayons during the period at a cost of $145,600. So let's find our direct labor cost variance. Well, our direct labor cost variance was $20,800 unfavorable. How did I get there? I took the actual cost that we paid per hour, subtracted out the standard cost that we set forth per hour, and multiplied that difference times the actual quantity. So what was our actual cost per hour? Well, if we go back up, it was $145,600 that we paid for direct labor, and our employees worked 10,400 hours. So if we took $145,600 divided by 10,400, it comes out to $14 per hour, which is $2 more than the $12 that our HR manager set forth when he or she set the standard. So if we paid $2 an hour more than we thought we were going to for labor, and our employees worked 10,400 hours, that means a $2 per hour increase for that amount of hours caused us to have to pay $20,800 more for labor costs than we should have according to our flex budget. Now let's go to our efficiency variance. In our efficiency variance, our actual quantity of 10,400 hours our standard quantity can be subtracted from our actual quantity of 10,400 hours, and our standard quantity was 13,000 hours. Well, how did we get there? Again, we made 52,000 batches of crayons. And our production manager said it should take about a quarter of an hour to make a batch of crayons. So 52,000 times 0.25 is 13,000, which means our employees actually spent 2,600 hours less than they should have according to our flex budget. They got this done way fast. And if we multiply that by our standard cost of $12 per direct labor hour, we come up with $31,200 favorable direct labor efficiency variance. And it's favorable because it's good for the company when your employees take less time to make something than they should have. So we had to start with that $10,400 favorable direct labor variance? Can it be attributed to the fact that we paid our employees less per hour, or is it attributed to the fact that our employees got things done much faster than we thought they were going to? And the answer is we had a huge unfavorable direct labor cost variance because we paid $2 more per hour, but it was more than offset by the fact that we had a very favorable efficiency variance. Our guys got it done way faster than we thought they were going to. So as you're going through, what do you do here? And you probably go to the human resource manager and ask why you're paying $2 per hour more than you thought you were going to. And this variance is also huge, even though it's favorable. They call it management by exception. That is a gigantic number. You still have to look into it. You would go to your production manager and why are you guys getting things done so much faster than you set forth, in fact, in your standards. And I got a feeling that these two numbers are linked, right? If an employee is good at their job, they will have been there for a while, they will have gotten raises, which means it would cost more per hour, which is what they should get for being rewarded for being an excellent employee. But since they are good at their job, it's going to take them less time to do. So I think these two numbers right here are linked, and Cheerful Colors just basically had too many skilled. The employees that they had making the crayons were much more skilled and expensive than they should have been with the way that they set up their scheduling in the first place.